Disclaimer.
In 2024, a country that most Americans barely think about quietly purchased over 100 tons of gold worth more than $8 billion. No headlines, no press conferences, no wire transfers through any bank you've ever heard of. Just gold moving through shadow channels, specifically engineered to route around the dollar, around our financial system, around everything we built to keep the global economy accountable. That country was Iran. And then, in September 2025, the machine stopped. UN sanctions snapped back into place. Iranian gold trade was banned. Central bank assets were frozen. And then in February 2026, coordinated strikes changed the equation entirely. And gold surged from $5,100 an ounce to over $5,300 in a single trading session. Here's the question. Nobody's asking loudly enough. Where does that 100 tons of annual gold demand go now? The answer, and this is what should genuinely grab your attention, is that it's coming here. Into our market, into North American ETFs, into COMEX futures, into the portfolios of everyday American investors. And understanding why that matters starts with understanding what Iran was actually doing with all that gold in the first place. Think about what it means to run a country that can't use dollars. Iran has been locked out of the SWIFT banking network, frozen out of international credit markets, and watched its currency, the rial, lose over 90% of its value since 2018. When your national currency is collapsing that dramatically and no foreign bank will touch your reserves, you stop asking how to earn dollars. You start asking what you can hold that nobody can freeze. Gold is the answer every time. It has been for thousands of years, and it still is today. But Iran didn't just quietly stack gold bars in a government vault somewhere. They built an actual parallel financial architecture around it. Iranian government policy allowed exporters, businesses selling goods internationally, to receive payment in gold instead of dollars. That meant gold wasn't just a store of value for them. It functioned as currency. It moved goods. It settled debts. It kept an entire sanctioned economy breathing when every conventional option had been cut off. Here's where the story gets almost cinematic. According to reporting from Iranian news sources and World Gold Council data, a single airport, Khomeini International in Tehran, processed over $14 billion in import value in 1 year. Gold accounted for more than half of that figure. We're talking about 96 tons of precious metal moving through one airport on commercial passenger flights, officially and openly. Not smuggled in duffel bags, moved with paperwork, on scheduled routes because the government had built the legal structure to make it possible. Pop quiz. When was the last time you thought about what was in the cargo hold of an overseas commercial flight? And it wasn't just domestic economic survival either. When Iran sold its Shahed drones to Russia during the Ukraine conflict, part of that transaction was reportedly settled in gold bullion. Gold became the settlement currency for weapons deals between two sanctioned nations, because both of them had been cut off from everything else. You couldn't sanction the metal sitting in a vault. You couldn't freeze what had no account number. This is exactly the lesson that central banks around the world, not just Iran's, have internalized deeply over the past decade. No government can freeze what's physically sitting in your vault. No executive order can reach a gold bar stored outside the dollar system. When the World Gold Council tracks why central banks have been buying at record levels for 3 consecutive years, this is the core answer. It's not sentiment. It's not tradition. It's a calculated response to watching Iran, Russia, and Venezuela get financially isolated overnight and deciding you don't want to be next. For regular Americans, this might feel abstract. Our dollar isn't going anywhere. Our banks aren't getting sanctioned. But here's what makes this story directly relevant to our money, our savings, and our portfolios. Iran wasn't just buying gold for its own sake. It was pulling gold off the global market, consistently, quietly, and in enormous volume, and locking it away where it couldn't circulate back. 100 tons a year, year after year, absorbed and held. That steady, invisible pressure has been tightening physical gold supply for years, without most investors ever realizing it was happening. Now that pressure is gone, the channel is sealed, but the gold isn't coming back out, and demand hasn't fallen, it's relocated. And the implications of that shift are playing out in real numbers right now in markets that affect every American who owns a coin, a bar, an ETF, or a mining stock. On August 28, 2025, France, the United Kingdom, and Germany made a quiet but consequential move. They triggered something called the UN snapback mechanism, a legal lever built into the original Iran nuclear deal that allows signatories to reimpose the full architecture of UN sanctions without a Security Council vote. No Russian veto, no Chinese obstruction. Just a procedural trigger, and 30 days later, the sanctions landed. September 28, 2025. The ban on gold and precious metals trade with Iran was back in full force. The Central Bank of Iran's international assets were frozen, and the commercial flight routes that had been quietly carrying bullion into Tehran, gone. Just think about the scale of what that means in market terms. Imagine someone pulling 100 tons of gold off the global market every single year and sealing it in a vault in Tehran. That vault is now closed. The gold already inside isn't coming back out, but more importantly, no new gold is going in either. The consistent, steady demand that had been quietly tightening supply for years just vanished from the equation overnight. Basic economics tells you that when consistent demand disappears, prices should soften. But that's not what happened, not even close. Then February 2026 arrived, and with it, coordinated US-Israeli strikes on Iranian targets. Markets don't like uncertainty, and geopolitical shocks of that magnitude create the kind of fear that sends investors sprinting toward anything that holds value when paper assets feel fragile. In a single trading session, gold surged from $5,100 an ounce to over $5,300. That's a $200 move in one day, the kind of price action that gets the attention of every portfolio manager, every retirement account holder, every financial advisor in the country. Have you noticed that gold has been making all-time highs with a frequency that feels almost routine lately? There's a structural reason for that, and the Iran story is a big part of it. Here's the mechanism worth understanding clearly. The geopolitical pressure that shut down the Iranian channel didn't reduce the world's appetite for gold, it intensified it. Every investor who watched those events unfold and asked themselves, where should my money be right now, arrived at the same answer that Iranian exporters and Russian defense ministries had already reached. You hold what can't be frozen, what can't be inflated away, what has held purchasing power through every crisis in recorded human history. And the numbers back this up in a way that's hard to argue with. North American gold ETFs, the funds that let everyday investors own gold without storing it themselves, recorded 8 consecutive months of net inflows heading into early 2026. In January 2026 alone, $7 billion poured into those funds. Not globally, just North America. That's our money from our investors flowing into gold at a pace that reflects genuine conviction, not short-term speculation. Over at COMEX, which is the primary American exchange where gold futures are traded, total net long positions rose 23% in September 2025, right as the UN sanctions landed. Trading volume jumped 58% month over month. The market wasn't panicking, it was repositioning, deliberately and at scale with professional money leading the way. And then came the record. In January 2026, COMEX gold futures hit $5,626 per ounce, an all-time high. To put that in perspective, gold was trading around $2,000 just a few years ago. The move from there to here isn't a bubble or a mania. It's a measured, multi-year repricing of what physical, uncorrelated, unsanctionable assets are worth in a world where geopolitical fractures keep widening. What if I told you that the most sophisticated banks on Wall Street, institutions that make money by being right, not by being dramatic, are forecasting this run has further to go? JP Morgan's global research team has put a $5,000 per ounce target on gold by the end of 2026, with a pathway to $6,000 over a longer horizon. UBS is projecting a $5,000 average for the year. Standard Chartered sits at $4,800. These aren't gold bugs or newsletter writers. These are the research desks of the largest financial institutions in the world, and they're telling their clients the same thing the data is already showing. The Iranian gold channel closing didn't cool the market. It accelerated a shift that was already underway, pulling more American capital, more institutional money, and more central bank reserves toward the same asset that a sanctioned nation had quietly been using as its financial lifeline for years. The irony is almost elegant. The same instrument Iran used to survive being locked out of our system is now the instrument our own investors are using to hedge against the instability that locking Iran out helped create. But the flow of money tells only part of the story. To understand what this actually means for anyone holding physical gold, coins, bars, ETF shares, mining stocks, you have to look at what's happening beneath the headline price, because the physical market and the paper market are starting to behave very differently, and that gap has real consequences for real people. Here's something most financial news coverage glosses over entirely. There are actually 2 gold markets running simultaneously right now, and they are not telling the same story. The first is the paper market. That's COMEX futures, ETF shares, derivatives, instruments that represent gold without requiring anyone to physically move a single bar. It's fast, it's liquid, and it's what most people are watching when they check the gold price on their phone. The second is the physical market. Actual metal, held in actual vaults, traded between buyers and sellers who want the real thing in their hands. And right now, those 2 markets are fracturing along geographic lines in a way that hasn't happened at this scale in years. Take Shanghai. Physical gold premiums there are currently running $30 to $35 above the COMEX spot price. That means a buyer in China is paying significantly more for actual metal than the exchange price would suggest, because physical supply is tight and demand is intense. Now look at Mumbai, where the opposite is happening. Gold is trading at a $65 discount to spot, reflecting weaker local demand and excess supply in that corridor. Same metal, same global price benchmark. Completely different physical reality depending on where you are in the world. Why does this matter to you? Because if you're holding physical coins or bars rather than paper ETF shares, your real-world asset value may already be running above what the exchange price is showing you. When geopolitical tension spikes, and we've had no shortage of that lately, physical premiums detach from paper prices. The exchange tells you one number, the dealer tells you another. In times of genuine stress, the dealer's number is the one that actually matters, because that's what you can transact at. This gap between paper and physical has been a defining feature of every major gold market disruption in modern history, 2008, 2020, and now again in 2025 and 2026. Each time, the investors who understood they were holding two different things fared better than those who assumed the exchange price was the whole story. Then there's the central bank dimension, which is arguably the most structurally significant piece of this entire puzzle. China has now accumulated gold reserves for 16 consecutive months, bringing their official holdings to 2,308 tons. And that's the reported figure. Most analysts who study Chinese monetary policy believe actual holdings are meaningfully higher because Beijing has historically understated its gold position during accumulation phases. Poland, Turkey, Kazakhstan, central banks across 3 continents are buying month after month with no sign of slowing down. According to World Gold Council data, central banks collectively purchased over 1,000 tons of gold in both 2022 and 2023, and the pace has remained elevated since. Here's the supply math that makes all of this so significant. Global gold mines produce roughly 3,500 tons per year. Central banks alone are absorbing more than a quarter of that annual production. Add in jewelry demand, industrial use, and the ETF inflows we just discussed, and you begin to understand why the market can't find equilibrium at lower prices. The Iranian channel closing removed one consistent buyer. But the institutional buyers filling that void are larger, better capitalized, and showing no signs of stepping back. So what does a thoughtful, informed American investor actually do with all of this? Let's be clear about what this is and isn't. This isn't a signal to panic or to liquidate everything and bury gold in the backyard. The data doesn't support fear, it supports awareness. There are 3 specific shifts worth understanding as you think about your own financial position. First, physical supply is structurally tighter than the headline price suggests. Iran was quietly absorbing metal and removing it from circulation for years. That channel is closed, but the accumulated effect of that removal doesn't reverse overnight. The physical market is operating with less slack than it has had in a long time, which is why premiums are elevated and why dealer inventory turns faster than it used to. Second, the gap between paper gold and physical gold is worth understanding before you need to understand it. If your gold exposure is entirely through ETF shares and you've never thought about what happens to that position during a genuine liquidity event, now is a good time to think about it. That's not fear. That's basic financial literacy about the instrument you own. Third, and perhaps most importantly, the buyers driving this market are not retail investors chasing headlines. They are central banks with decades-long mandates, sovereign wealth funds rebalancing away from dollar concentration, and the research desks of the largest financial institutions in the world. When that class of buyer is consistently on one side of a trade, the informed response is to understand why. Not to assume they know something you don't, but to examine the same data they're examining and reach your own conclusion. And that brings us to the bigger lesson, the one that ties this entire story together in a way that goes beyond any single price target or market forecast. Iran, a country that has spent decades locked out of the global financial system our country built and maintains, did what human beings have done for 5,000 years. When the institutions around them became unreliable, they held gold, not because it's glamorous or traditional or nostalgic, but because it works. Because no sanction can reach it. Because no printing press can dilute it. Because when the rial lost 90% of its value and the banks were frozen and the SWIFT code stopped working, gold was still gold. The difference between an Iranian exporter receiving gold instead of dollars and an American retirement saver allocating a portion of their portfolio to precious metals is enormous in terms of circumstance, but surprisingly small in terms of underlying logic. Both are responding to the same fundamental reality, that financial systems, no matter how powerful or well-intentioned, carry risks that aren't always visible until they materialize. What should strike us as Americans, as people who benefit enormously from living inside the world's reserve currency, is that the rest of the world has been watching our financial system carefully and making quiet preparations. 16 consecutive months of Chinese central bank buying isn't a coincidence. The UN snapback that sealed Iran's gold channel wasn't the end of gold's geopolitical role. It was a redirection of it, straight into our market, where the same metal that kept a sanctioned economy alive is now being absorbed by the most sophisticated investors and institutions our country has to offer. Money has always flowed toward where it's respected, toward where it's protected, toward where it holds its value when everything else is uncertain. And right now, judging by the numbers, the flows, the forecasts, and the fundamentals, it's flowing into metal.